Welcome to this custom-tailored deep dive.
Yep.
We actually crafted this specifically for you. Our mission today is an ambitious one. We need to make sense of what has undeniably been a completely chaotic, whiplash-inducing week in the global markets.
Yeah, whiplash is definitely the right word for it.
It really is. Today is Friday, March 6th, 2026, and you and I are currently watching the world navigate just this perfect storm of macroeconomic shocks, geopolitical conflict, and some truly intense volatility across traditional and digital assets.
Right, and to give you the best picture, we've gathered a massive stack of sources to draw from today.
Exactly. We are pulling market reports from Capital Street FX and TradingView.
Yeah.
We've got deep analytical research from Crypto.com and Crypto Briefing, on-chain data flows from Protos and CoinGeek, traditional economic metrics from Kitco, and the latest regulatory updates directly from NASDAQ.
That's a lot of ground to cover.
It is. Okay, let's unpack this. In a week where a major war has erupted in the Middle East, where crude oil has spiked violently, and where the U.S. economy unexpectedly shed nearly 100,000 jobs out of nowhere, why is Bitcoin experiencing such a massive identity crisis? Over the last 5 days, it has acted simultaneously as a safe haven, a risk-on tech asset, and, incredibly, the preferred base money of artificial intelligence.
It's just a phenomenal stress test of literally every economic theory we've been operating under for the last decade. We're seeing institutional capital, retail panic, and algorithmic logic all colliding in real time.
Which is exactly why we're here.
Right. I'm really looking forward to helping you connect the dots between this global conflict, the sudden resurgence of inflation fears, and the rapidly shifting foundation of the crypto market. Because looking at the data, none of these events are happening in isolation.
Not at all. Let's get right into the geopolitical shock that took center stage this week. Operation Epic Fury, the coordinated U.S. and Israeli strikes inside Iran, is now entering its 7th day. The rhetoric surrounding this has been intense. To give you a sense of the political temperature, former President Trump posted on social media this week demanding that Iran accept unconditional surrender.
And before we dig into the market reaction to those developments, I do need to explicitly state for you listening that while we are discussing the actions, policies, and statements of political figures like Donald Trump or the Biden administration, we are strictly reporting the facts, just as they are presented in our source material. We take absolutely no political sides on this deep dive. Our only mandate is to impartially analyze the market impact of these events.
Absolutely. Strictly the market impact. And looking purely at that impact, the data shows an immediate violent reaction in the energy sector. West Texas Intermediate, or WTI crude oil, jumped 16% this week.
16%?
Yeah, hitting $88 a barrel almost overnight. The obvious fear driving that spike is the potential closure of the Strait of Hormuz. With roughly 20% of the world's daily oil supply transiting through that specific choke point, the market is pricing in a severe disruption to global logistics.
And that 16% jump, it isn't just a number on a screen. It's an immediate input cost increase for every manufacturer and shipping company on the planet. When energy spikes that aggressively, it acts as a highly regressive tax on the broader economy.
It trickles down to everything.
It does, and it sets up a brutal collision course with the other massive shock we saw this week, which is the Friday jobs report from the Bureau of Labor Statistics.
Oh man, that report was a genuine stunner. Wall Street was pricing in a gain of 59,000 jobs for February. Instead, the BLS reported that the U.S. economy unexpectedly lost 92,000 jobs.
A massive miss.
And the unemployment rate ticked up to 4.4%. But hold on, we've seen payroll misses before. Why is a 92,000 job loss triggering such a massive structural panic across the trading desks?
Because of the underlying mechanics causing that loss. The Kitco report breaks down the specific anatomy of this miss, and it's a very specific confluence of distortions. You have the immediate impact of Trump's sweeping 10 to 15% global tariffs.
Which essentially froze the manufacturing sector as supply chains scrambled to reprice.
Right, exactly. Then you add in the acute uncertainty of the conflict in the Middle East causing corporate hiring freezes. On top of that, there was a localized but massive strike by 31,000 Kaiser Permanente healthcare workers.
That's a huge chunk right there.
Yep, compounded by significant structural job shedding in both the information technology and federal government sectors.
So it's not just a localized weakness in one area. It's a broad-based retraction hitting manufacturing, tech, healthcare, and government all simultaneously.
Precisely. If we connect this to the bigger picture, this creates a textbook stagflationary signal.
Stagflation, the absolute worst-case scenario.
Right. High oil prices historically force inflation back up, which pressures the Federal Reserve to hold or raise interest rates. But a sudden shedding of nearly 100,000 jobs means the economy is deteriorating rapidly, which normally demands that the Fed cut rates to stimulate growth.
They're trapped.
They are staring down a dual mandate trap, where any move they make with interest rates will actively worsen half of the economy.
Usually when the macro picture looks this grim war breaking out, inflation threatening to rebound, and employment contracting, capital blindly flocks to traditional safe havens. Gold and oil are the historical default settings.
Sure.
But early in the week, the data tells a completely different story. According to the on-chain analytics from Protos, Bitcoin surged 12.1% in the first 4 days of the war, peaking at $73,419.
A huge move.
Yeah. Oil gained 10.4% in that same window. But gold, the ultimate multi-millennia safe haven, actually dropped 3%.
Which caught a lot of people off guard.
Totally. Even Nvidia, the undisputed heavyweight of the stock market, only managed a 2.8% rally. When the missiles started flying, Bitcoin outpaced everything.
It's a fascinating contrarian rally that defies a century of conventional market wisdom. The Crypto.com analysis dives deep into this divergence, referring to gold as the hedge that wasn't this week.
The hedge that wasn't. I like that phrasing.
Right, because remember, earlier in the year, gold had surged past $3,500 an ounce entirely because central banks were aggressively hoarding it. But when acute, localized panic hits retail and institutional traders, physical gold presents immediate liquidity and settlement issues.
You can't just easily send a gold bar across borders during a crisis.
Exactly.
But wait, if gold is dropping because of liquidity crunches, why did Bitcoin suddenly abandon its own rally? Because by Friday, the second that disastrous BLS jobs report hit the wire, the narrative completely flipped.
It really did.
Bitcoin tumbled right back down below $69,000. It stopped acting like a censorship-resistant wartime haven and immediately started trading in lockstep with the S&P 500. It behaved exactly like a high-beta tech stock reacting to a recession fear.
That is the core of Bitcoin's current identity crisis. Despite years of being pitched to you and me as digital gold, it still struggles to maintain that decoupling during moments of acute macroeconomic stress.
Because it's still treated as a risk asset.
Yes. When liquidity dries up and broader market fear spikes like a surprise jump to 4.4% unemployment, we see traditional funds liquidate their most volatile assets, first to cover margin calls or manage risk across their portfolios. Right now, algorithmic trading bots on Wall Street still largely bucket Bitcoin alongside high-growth tech equities.
Well, speaking of algorithms, here's where it gets really interesting. If Wall Street's trading bots see Bitcoin as a tech stock, the next generation of artificial intelligence sees it as something entirely different.
This is my favorite part of the data stack this week.
It's wild. The sources highlighted a massive recent study that ran 9,072 isolated experiments across 36 different frontier AI models. The researchers prompted these AI agents to select an optimal monetary asset from all available global options.
And the results were staggering.
48% of the time, the AI autonomously chose Bitcoin. And when asked specifically to select a store of value, the AI models picked Bitcoin 79% of the time. Anthropic's Claude Opus 4.5 model actually selected it a staggering 91% of the time.
91%.
So basically, while human traders are panicking over tariff impacts and jobs data, Claude is out here logically stacking sats. Good to know the robots have a solid investment thesis.
It is genuinely one of the most profound data points in the stack this week. It highlights the fundamental difference between human emotional trading and algorithmic logic.
Because humans panic.
Right.
Yeah.
Humans trade based on narrative, fear, and institutional momentum. These advanced logic engines are simply analyzing the mathematical properties of money. They are looking at verifiable scarcity, the impossibility of arbitrary supply inflation, and programmatic settlement.
The AI isn't driven by politics.
No, the AI isn't choosing Bitcoin because of a political ideology. It's selecting it because, computationally, a fixed supply of 21 million units is the most efficient mathematical container for storing value over time.
That is wild to think about. We're arguing over whether there's a risk on trade and the models are just doing the math on absolute scarcity. But I want to pivot from the theoretical future of AI economics to the very gritty physical reality of right now.
We need to.
To really understand how crypto is being utilized on the ground during this conflict, we need to look at the CoinGeek report covering Iran. Right after the U.S. and Israeli airstrikes commenced, the Iranian crypto exchange Nobitex, which is a massive platform with 11 million active users, experienced a 700% surge in outgoing transactions.
That specific metric tells a story of absolute desperation. You have millions of Iranian citizens watching their national currency. The serial face total collapse under the immediate pressure of military strikes.
Right.
In that environment, traditional banking infrastructure becomes a trap. So they frantically started converting whatever wealth they had left into crypto to move it offshore, completely bypassing the highly sanctioned, state-controlled financial system.
And the only way the government could stop that capital flight was by employing the nuclear option of censorship. The Iranian regime literally initiated a 99% internet blackout across the country.
Which is terrifying.
Think about the implications of that. The only way a sovereign nation could stop a decentralized blockchain network from draining its wealth was to pull the plug on the entire country's internet access.
It is the rawest possible demonstration of censorship resistance. It proves that in a true crisis, the network functions exactly as designed, facilitating peer-to-peer wealth transfer without permission.
But there's a catch.
There is. It also brutally exposes the physical vulnerability of the infrastructure. A blockchain might be decentralized, but the ISPs and the fiber optic cables connecting the users to that network are highly centralized and state-controlled.
So Bitcoin is proving its utility in active conflict zones. But if you look at the rest of the crypto market, it is an absolute bloodbath.
A total slaughter.
The Crypto Fear and Greed Index has plunged down to 18, which puts us deep into the extreme fear territory. According to the Capital Street FX data, the altcoin sector is being slaughtered. 38% of all altcoins are currently sitting at absolute all-time lows.
That's a massive wealth wipeout.
Ethereum took a massive hit, dipping below the psychologically critical $2,000 level. Solana dropped 5% down to $85. And XRP is enduring its fifth consecutive monthly loss, grinding down around $1.36. Capital is evacuating these smaller, smart contract networks at an alarming velocity.
It's a classic flight to safety, but what's notable is how that capital is fleeing.
What do you mean?
Well, in previous cycles, when altcoins collapsed, retail investors would cash out completely back into fiat currency in their traditional bank accounts. This time, they are staying within the ecosystem. The data shows U.S. Treasury-backed stablecoins experienced a massive 28.9% gain in transactional volume over the week.
Which means they aren't actually leaving the casino. They are just cashing out their chips and standing by the table.
Precise.
They're liquidating volatile assets like Solana and Ethereum and parking that value in on-chain dollars. It's the digital equivalent of stuffing cash under the mattress while you wait to see how bad the macroeconomic storm gets.
Exactly. They're positioning themselves to deploy that capital instantly when the market bottoms out. Going through a multi-day ACH bank transfer to buy the dip is too slow in a market that moves this fast, so the capital stays parked on-chain in stablecoins.
But while retail investors are paralyzed by extreme fear and hiding in stablecoins, the institutional whales are doing the exact opposite.
Oh, they're accumulating.
Big time. The big money is using this volatility as an accumulation event. Strategy Inc. aggressively bought the dip, acquiring another 3,015 Bitcoin at an average price of $68,700.
Unbelievable scale.
That single purchase brings their total corporate treasury holdings to roughly $49 billion. And it's not just aggressive corporate treasuries. The traditional Wall Street machinery is firing on all cylinders. The spot Bitcoin ETFs absorbed $1.45 billion in net inflows over just 5 days of trading.
5 days.
That is $1.45 billion of traditional finance capital flowing into the asset while missiles are in the air and the U.S. is shedding 92,000 jobs.
This represents a fundamental structural shift from every previous crypto market cycle. The presence of Wall Street ETFs and massive corporate treasuries has built a demand floor that simply didn't exist before.
The guardrails are up.
Exactly. When retail traders panic sell based on a geopolitical headline or a scary jobs report, these institutional vehicles step in and absorb that supply. They are operating on a multi-year or even multi-decade time horizon. A bad monthly jobs report from the BLS is irrelevant to a sovereign wealth fund or a massive corporate treasury looking to hedge against long-term fiat debasement.
And that institutional appetite is creating massive friction in Washington. The NASDAQ report highlights an intense political pressure campaign unfolding right now.
Let's hear it.
President Trump is aggressively pressing major U.S. banks, demanding the swift passage of two massive pieces of legislation, the Clarity Act and the Genius Act, with the latter focusing heavily on comprehensive stablecoin regulations.
Right.
He took to Truth Social, publicly warning banks that they must not hold the Clarity Act hostage and threatening that the entire digital asset industry will move overseas if the traditional banking sector doesn't get out of the way. Now, as we wade into this legislative maneuvering, I want to clearly remind you, our listener, that we are neutrally reporting these political developments strictly from our sources at NASDAQ.
Important distinction.
We are not endorsing any political framing or candidate. Our focus is solely on how this regulatory pressure campaign impacts the flow of capital in the markets.
And the stakes for that capital flow are astronomical. The friction isn't just domestic either. We are seeing a major philosophical clash between the US and the UK regarding the future of tokenized finance. The UK is currently pushing for a highly cautious, methodical approach. They are trying to establish a regulatory sandbox where tokenized real-world assets and securities can be tested slowly in a tightly controlled environment. The US SEC, on the other hand, is suddenly pivoting to move much faster, pushing for what they term exemptive relief to allow these blockchain projects to launch and scale rapidly.
Why the sudden rush from the SEC? We've watched them drag their feet for years. What changed?
The realization of how much money is sitting on the sidelines. If we connect this to the bigger picture, this raises an important question for you to consider regarding market timing. How much institutional capital is legally constrained, just waiting to the specific regulatory clarity?
Billions, easily.
The estimates from JP Morgan suggest that if the Clarity Act actually passes by mid-2026, it could instantly unlock billions of dollars from pension funds, endowments, and sovereign wealth entities that are currently legally barred by their own charters from touching digital assets without explicit federal frameworks.
So what does this all mean for you as you try to navigate this market? Let's bring all these disparate threads together. We are looking at a deeply complex macro trap, a 16% ill shock threatening to reignite inflation, colliding head-on with a disastrous jobs report that screams recession, leaving the Federal Reserve with no good options.
Not at all.
In the center of this storm, Bitcoin is exhibiting a truly dual personality. Depending on the day of the week, it acts as a high-beta tech asset riding Wall Street's ETF inflows, and the next, it proves itself as a literal censorship-resistant escape hatch for millions of citizens fleeing collapsing fiat currencies in war zones.
A true duality.
And all the while, the broader altcoin market is bleeding out, with extreme fear driving retail capital into the temporary safety of US dollar stablecoins.
It is an overwhelming amount of noise to process, but I would encourage you to look at the historical context of these specific metrics. An extreme fear index reading of 18 is psychologically uncomfortable, but historically, these zones of deep capitulation are precisely where patient, long-term capital accumulates generational assets.
Buy when there's blood in the streets, as they say.
Exactly. The institutions deploying billions of dollars into Bitcoin ETFs this week aren't trading the 24-hour news cycle or the latest political post. While absolute caution is required, especially given the very real structural stagflation risks we unpack today, you have to try and look past the daily volatility. Focus on the tectonic shifts happening underneath, the looming regulatory frameworks like the Clarity Act, the relentless corporate accumulation, and the undeniable real-world utility being proven under fire in places like Iran.
That structural perspective is vital. And to leave you with a final provocative thought, to ponder something that builds on that fascinating AI study we discussed, but takes it a step further.
Go for it.
We know from the source data that in isolated experiments, the most advanced AI models in the world are already autonomously selecting Bitcoin as their optimal store of value. But let's extrapolate that. What happens when these AI agents graduate from theoretical experiments and become fully autonomous economic actors running corporate treasuries or executing high-frequency global trade?
Oh, wow. That's a huge thought.
Right. If the baseline logic of an AI dictates that a mathematically scarce, decentralized asset is the only rational reserve currency, we are rapidly approaching a reality where global superpowers won't just be competing with each other for Bitcoin reserves. They will be actively competing for liquidity against a massive, non-human, machine-to-machine economy that never sleeps, never panics, and mathematically hoards the asset.
It's inevitable.
Will central banks eventually be forced to deploy their own AI agents just to fight for a share of a 21 million cap supply? It fundamentally changes the definition of a global financial arms race. Thank you so much for joining us on this deep dive into the source material.
Yes, thank you for listening.
We hope exploring these distinct perspectives helped clear the noise of a truly chaotic week in the markets. Keep exploring, stay curious, and we will catch you on the next one.